Ugh,
Good
dang.
evening.
We almost it was 2 seconds left on the clock
Yeah, we're
when
just sat
when I
chatting
know
away.
when I noticed that we were about to start, and I got stressed out, so I poked myself in the eye when I was trying to put my glasses on fast and clicking the button at the same time.
Professional streaming coming direct to your YouTube.
Hi, everybody. Welcome back to Crypto Talks. My name is Phil, and I'm joined again by Rob on this lovely Macro Tuesday that we've. This is the second time we're doing it as an actual its own thing.
Yeah,
which is
and
cool.
it is because we talked about it, and a lot of our TA Monday stuff, which was ideally crypto centric, kept straying significantly, and we keep trying to, in our ideal mind, have 30 minutes as a target for how long this is, but we keep straying to an hour, and so it did make sense to kind of split this up. And we still like doing the longer stuff, I think, so we need to be doing that, but it's sort of
I'll say this. I think Crypto Talks will be mainly 1 hour long stuff, so we really get through things. 30 minutes to an hour long videos, like live shows. If we do like we do on Thursdays that we started doing, which is the how-to thing, I will try to keep those, the ones that I do, to 15, max 30 when I'm explaining how to do something. And I think, Rob, you'll be doing some as well later on. And we should try to keep those a bit shorter because, if you pull it out too long, I think it's just going to be too much stuff in one video for people to kind of get it into their heads. Maybe. But okay, so I had some notes that I accidentally left at work, which is classic me. But we are going to look at the CPI numbers that came in. And we're gonna look at. Actually, let's just look at them right now. Might as well, right?
I think that's a compliment. Rob's vocal capacity is on Viagra.
Aw,
apparently.
That's so nice.
Yeah, I can't keep it short.
That doesn't go for everything, though, I'm sure.
Kind of everything.
Okay.
Right. Yeah.
Right, so let's look at the CPI. Okay, so was that a laughter?
That was a
fantastic. Okay. Sorry, everybody.
That's our number one listener, who is currently sat about 5 meters away from me, listening 10 seconds behind.
This is going to be a short.
Yeah.
Hey, perfect. It's going to be a short. Okay. Sorry. So CPI, it came in at 3.2, which is 0.5% lower than the previous. And I think, let's see where we are. Forecast was 3.3, so better than forecast. That's nice.
It's amazing how they have this magic wand that just is like, oh yeah, the numbers are going to be.
Yeah, well, I think it's a lot of people just voting on what they think it might be, and then that's kind of so. Either way, so we've seen. I'm actually going to go back. So once we were up here, when this peak had happened, the inflation peak had taken place, we were talking about how it's going to come down, and when it's year over year to the peak, it's going to bottom, and then it's going to come back up because of, it's peaking out. It has to kind of get that, another peak somewhere.
If you're measuring something from the highest possible baseline, it's going to be at its local minimum.
Precisely. So that's that's why we've bottomed out and then came up a little bit. But the inflation is coming down. Now we're measuring on the backside of this rather than the top of this. So we were measuring when this was going down, this line was going up. Now this line is going down, and we're just measuring the down line, which is why we're getting this peak. Yeah. But that's now changed, and it reversed faster than I thought, actually.
That's it. Things don't move in a straight line. However, the overall trend is very, very much in one direction.
Yep.
And maybe it bottoms somewhere, probably around 2%, and that won't, that's it. There's a fear that this is the fear is there's this secondary spike up in inflation, and I'm going to put sort of the argument towards why that's sort of highly unlikely, but it's the real fear is that shouldn't be in inflation. The real fear actually is deflation. As much as people think that deflation is good,
that sounds good. Things are getting cheaper.
In the sense that things are bad. That's like, no, deflation in a debt-based economy is a death spiral scenario.
Yeah, that's a kill switch for sure.
So and the thing is, they do know that there is a solution out of it. They can print money out of it. So but right now, the appetite for money printing is
low.
Well, it's necessary, but it's political suicide. It's not something that
nobody wants to do it.
Accept.
Because the people will go nuts.
It's gonna happen. It has to happen. I will say we'll talk a few things, and we won't spoil this.
Exactly. Okay, so what we're looking at right now is we're going back to what we had in July, right? Same rate of inflation. So there's still inflation, right? And a lot of people misunderstand this, and they look at this and they think that this means that inflation is 7%, or then it's 6.5%. In terms of like, people think the prices are going down when this is going down. No.
No, price is just increasing more slowly.
Yeah, price is increasing slowlier. That's a great word. I want to start using that. Okay, so we have this, and this is not really the number that the Fed is looking at to kind of decide. They look at, I think it's the PPI as well, but they also talk more about the core inflation, which is this one.
So
but
that's
luckily,
just excluding what housing, food, energy, basically excluding all the things that you actually spend your money on. If you don't count any of that, then this is the number that they're looking for.
Yeah. Well, so October came out as forecasted right here, 4.1. Which is good. I mean, came out as 4. So it's good. And this means that, the chance of the Fed, I wouldn't say pivoting, but I don't think they're going to be raising rates now. Like, there was a small chance they would do. Everyone is talking about a pause again, which it makes sense, which I think we've talked about when we were looking at the charts last time. We're talking about how we would hold that flat level of interest rates for 9 months, 6 months, whatever we had. I can't remember exactly. We can look at that later. And then once we get into 2024, that's when we might start seeing rate, lowering of the rates.
You start to see the effect of high interest rates, which the market will incentivize lower interest rates, and it already kind of is. However, the Fed are sticking to their guns, and whether that's a good or bad thing is debatable.
Yes. Oh, crud. There we go.
Wow.
Now here's what I was talking about. Here's the flat area that we were talking about. I don't think this has appeared yet. Has it? No, it hasn't. I think this will come out next month. Is it that far between? When it's updated?
I don't know. Whenever the next meeting is, and they.
Yeah. Oh yeah. Right. Yeah. That's true. Yeah. So we'll see some flat area here that we did right here, and so on. And after that, the orange line here is the Bitcoin halving. I don't think we're gonna be flat for that long. They're gonna start lowering before that. I'm not gonna promise anything, but I have a feeling. But yeah, that's the chart I was just talking about there. So let's go back to this one. There we go. But yeah, so CPI is down. It's looking pretty good in terms of what the goal is to get down to. I think it's 2%, or was it 3%?
I think 2% for core is the target. And if you think, say what, one of the big parts, I think if you go down, then you can see what the core CPI is made up of. I think, is it
right
below?
I think it's not in here.
No, I thought it was on there. But housing has been something which has been particularly sticky, and that's because people don't want to move, they don't want to lose the house, so people will find the money to pay their rent at the expenses of other things. People will pay their mortgage at the expense of other things. So these house prices for a certain amount of time will be borne. They'll be bear. People will bear it. How sustainable that is, eventually people will start to sort of fall off the cliff. And but as it stands, there's no real reason for houses to drop in price, because people will just not sell. People don't want to take the loss. They'll just ride it out. If they're struggling, they'll afford the payments. They'll keep on paying those higher costs. But even that will plateau at some point. And one of the drivers of rising interest rates so high will be to drive down the price of housing. It has to. Unfortunately, the method of doing that is that it will, and this is what the Fed are intentionally doing. The Fed are intentionally making houses unaffordable for some people who already have mortgages. That they're intentionally forcing them into delinquency. That's an inevitable thing that they're doing. Driving down demand is the goal that they keep talking about. Well, housing is something like 18% of GDP. So if you're driving down demand for things, that includes housing.
Yep.
Yeah. That's the
truth. That's the last thing that goes too, because people will sell their car and get a cheaper car before they lose their house, and then
they'll work more hours. They will do anything they can to not lose their house, their biggest asset in most cases. But people are being pushed further and further into unaffordability, and you've got to think the longer that these interest rates are held, the more people come to the end of their fixed term and suddenly have to refinance. And so I think this is probably quite sort of a good segue into what I want to talk about.
Yes, I was just gonna say, let's open your chart because you had it perfectly there. Yeah.
So this is what people are kind of scared of. This is back in the 1970s, and you see this is the federal funds rate essentially chasing inflation. I won't put inflation on here, but basically inflation was doing this, and the Fed rocketed interest rates up to highs of 19%, was it? 19% in order to combat inflation, and they succeeded. So there's one big difference on this chart, and that is the orange line. And the orange line is the US debt to GDP. So back in the 70s, coming out off the back of World War II, the US debt to GDP was continually reducing. So you have all of this inflation, but all of this inflation was driven by the baby boomers all entering the workforce all at once, the largest generation in history up to that point. Every single one of them needed a house. They needed cars, they needed washing machines, they needed tables, they needed clothes. They all needed goods. And this was at a time when US made most of their own stuff. They were an exporting nation, they were a manufacturing nation, not so much anymore. And so you had this incredible demand for stuff and an incredible demand for labor. So what happened was there just was the more and more money was being created because more people were getting jobs that entitled them to loans that meant they could borrow in order to buy stuff, which meant they could pay the higher prices, which meant that people could put wages up, and you had this big positive spiral, but it was driven off growth. And the actual effect on the debt, the orange line is the debt to GDP. The debt was remaining relatively low. It was hanging around at sort of 35%. We're currently at 130%, 129%. And
can I ask you something as well? Just now that we're at 133, I think it is, right?
There's 129 on this chart, but it only gives it every 12 months. So
right. So a lot of people, specifically other content creators, they're talking about once you get to, well, not a lot, but the good ones that I like, they talk about how once you get above 77%, there's basically no turning back. You can't really fix it at that point. And being at 130 that's more than 77, right?
It is. However, I'm going to.
So what does that mean?
Okay, so can I just counter that? Which is the US the US GDP is significantly higher than the number given, because you have to remember that US GDP is a function of global GDP. The US are the largest consuming nation, and they have the dollar. That we live in a dollar-denominated system, and so the US is that part of the remit, part of the responsibility of having the world's reserve currency is that you need to provide liquidity outside your own country to facilitate payments around the world in that currency.
Mm-hmm.
And so you have to remember that what the US debt really is the US debt is a facility for people to access dollars globally around the world. They're just, a $100 US Treasury carries the same weight as a $100 bill, essentially. People can borrow against it. You can if I own $1 billion worth of US Treasuries, I can borrow essentially $1 billion from a bank against that. In the case of the way that the actual banking system works, so I can borrow much more than $1 billion against that. And so what you have is that the US has this requirement to provide dollars to the world, and if it doesn't, the way that it can do that best is by issuing government debt. And so what you have is a problem where the US has to export dollars to the rest of the world. And what we're seeing in this era of sort of really extreme financial tightening is actually there's a suck of dollars away from the world. And so the US debt is much less of a problem for the US than it is for other countries. For other countries, 113% debt to GDP is very, very hard to manage, primarily because if you don't have a world reserve currency, you have to find buyers for your debt in your own currency. And if they don't trust your currency, then they're going to demand very, very high interest rates in order to lend in that currency, especially if you've already got high debt. And so what you have is the likes of Sri Lanka as an example, where the last numbers I saw, I don't quote me on whether this is accurate now, but it was 24% was what they were paying on their Sri Lankan rupee bonds. Now, name an investment that you can make that will make you 24% return ROI per year, risk-free. And so all of a sudden, for Sri Lanka, if you have Sri Lankan rupees, what is the point in making any investment inside Sri Lanka? It's not going to yield you 24%. If your goal is to make more rupees, just buy government bonds. So there's absolutely no point in investing in the economy if you're a private citizen. There's only point in investing if you are the government. And how can the government invest? Because it doesn't have any money, because it can't raise any money, because its interest rate is too high, because it's a death sentence. And that's why you have, say, Sri Lanka. Its economy is essentially dead. It's in the process of becoming a failed state almost. There's not to say that it can't recover, but it needs some serious work. And the problem is that the overall financial situation globally is getting worse, not better. So the likelihood is that more nations are going to fail in the likes of Sri Lanka, of Venezuela, of Pakistan. Because what can Sri Lanka do? Well, all they can do is print rupees to hand out to their citizens to try and get them to build stuff. Well, if the citizens don't trust the money, then it just ends up being a death spiral. We've seen those hyperinflation death spirals, and they're not good. But the problem, that problem is not the same for the US, because the US will always have a continuous, ongoing demand for dollars.
Yeah,
and even in the sense of the US government, they charge one way that so you can guarantee US dollar demand is they charge interest on their debt. That debt is in dollars. They charge taxes. They tax all of their citizens, and what are those taxes paid in? They're paid in dollars. You have to pay them in their own currency. And So yeah, there will always be this demand for dollars. There isn't
Yep.
that same demand for other currencies. So yeah,
No.
that's the short version on why the
Yeah.
US can afford to handle this debt. Now, can that debt become unsustainable? Well, I'll show you how it kind of is becoming unsustainable on this next chart. So this is two
Yay, that's my favorite.
representations. It's a good chart, this. So there's two representations of it. One in white is the US interest rate multiplied by the US total government debt. And the orange line is the US 30-year treasury, which, so you can kind of look at these two together as going, this is the real interest rate on government debt is sort of somewhere between these two lines. Yeah,
Yep.
It can vary. It's, you know, and I could I'm sure I could find a more detailed chart, but this is pretty good. And so either way, we can see these numbers up here. So what this boils down to is this is roughly as an idea of the amount of interest per year that the US government are paying on their debt. And you know, we had say this kind of trend, this continuous sort of trend line, which you know, consider whether this happens during periods of economic growth. So each time we reach this peak, you know, these peaks of interest rates of debt, the market was bigger each time. You know, the GDP was each time, the amount of money was bigger each time, so they could afford a sustainably higher peak. But each time, yeah, you know, there's a limit on how much interest the government can realistically afford to borrow before its borrowing rate, its borrowing problem is excessive. And yeah,
so
that happened
a little bit extended, isn't it?
Yeah. So for anyone who can't see, that number is roughly somewhere between 1.5 and 1.8 trillion dollars is the interest rate burden on the US government.
Yep.
And that's money that has to be paid. That's this is for the US not to default on its debt. They have to provide this money. And so how do they provide this money? Well, there's two ways that they can go about it. They can either print money indiscriminately, which I think we can all agree there is not a political appetite to go out and just do trillions of dollars of QE. The Fed certainly aren't in a position to do it on the basis that they were still raising rates when, you know, QE is not something that you do while you're raising rates. QE is something that you do while you lower rates. What's happening is a period of financial tightening, not easing. And so if you can't print the money, you can tax your citizens anymore. I don't know how Americans feel about more taxes, but given the current sort of era of discontent and the fact that so many people that are suffering and struggling under their cost of living, raising taxes is not a popular opinion right now.
Mm-hmm.
And so the alternative is they can issue more bonds, and they can go, well, we haven't got this money, we've got whatever the deficit is it 3 trillion or so currently? I'm not sure what it currently is. But also this 1.8 trillion of interest, they're going to go, yeah, we're going to issue 1.8 trillion dollars worth of bonds. And so people will buy those bonds. As I mentioned, there is a constant global demand for dollars. People will jump at the opportunity, or, you know, governments, you think foreign governments, corporations, people who need big, large balance sheets that are stable, that are safe, and that are reliable. But, you know, 5% interest on government bonds, 6% interest on government bonds. Yep, I'll take that. I'll happily take that. And so, especially as the world gets more desperate for dollars, they will buy these bonds in higher and higher rates. But we still have this problem that there is a limit on how much money is willing to go into debt. You know, there's only so many billions that people are willing to say, I'm going to give you this and you're going to pay me an interest rate in exchange. You know, there's just a finite amount of money for any market. And so if you look at the sort of these levels where the last peak was sort of around 500 billion, if that every time that the government raise these interest rates and they have this demand for their debt, that is debt that is being taken away from the free market. The free market only has if they have a demand of say 5 trillions worth of debt in total, then the government are taking 500 billion of that. They're taking 10% of the total amount of debt that the market is willing to invest in.
Yeah.
If it's still 5 trillion, just using that number of example, I don't know what it really could be, but the government are now taking 1.8 trillion. Well, now that's 36% of that total number. That leaves a hell of a lot less debt willing to borrow to the actual private market, to the people who are going to borrow and create economic growth by taking out loans and starting businesses and investing. Now, and because the government are offering such high, healthy interest rates, they're offering 5%. And we talked about this, say, last week, is that what do you demand for a house if you're getting 5% from the US government? You want more. You want near 7, 8. What is the corporate debt? How much do you charge if you're a corporation? How much do you charge for credit cards? The interest rate for everything goes up and up and up, and that leaves a hell of a lot less room for discretionary spending for people to just live. Whether you're a corporation wanting to invest, wanting to do stock buybacks, whether you're a homeowner wanting to redo the roof, it doesn't matter what it is. It affects you whether you're a country or an individual. These high interest rates are a killer. And if you can get, there is a risk curve whereby the least risky debt carries the lowest interest rate. And the lowest interest rate sort of globally right now is over 5% for US government bonds. Everything else around the world must be a higher interest rate and a function of the risk. And it's a lot of interest for people to pay when they are in record amounts of debt. So just move on to the next chart, which is the same thing, the interest rate, but this is on US business loans. So again, you've got this kind of peak where the amount of debt paid peaks out as the interest rates go up, and then we end up having a recession. Why? Because the amount of debt that the economy is bearing is too much. And even here, the thing that people, I mention it regularly, is the COVID crash was always going to happen in some format. COVID was the catalyst, and obviously everything that happened afterwards was completely COVID related, but we were due this to happen. And you see this level, this sort of 60 billion of credit, which goes all the way back to the 80s seemingly, and now we're at 152 billion.
Yeah.
And this is just the interest rates that companies, corporations borrowing money are having to pay. 150 billion a year.
Yeah, that's nasty.
And this money has to come out of economic growth. It has to, because if you've got the same amount of economic growth and now you're suddenly paying all this interest rate, well, that's less money that you can spend on actually growing your economy.
Yeah.
And that's why interest rates drag on economies.
Well, this is one of the reasons why I was kind of surprised of the GDP growth last time. For the last stream, we had a 4.9 from a 2.1, I believe.
So there's I saw one good explanation for it.
Yeah.
Which is what was the fear a couple of months ago? Oh, inflation's going to come back. Inflation's going to come back, and so if you think about what that means for an economy, or if you're an individual, if you expect inflation to come back and you think you're going to get 10-11% inflation rates again, what are you going to do? Even if you can't really afford it, you're going to go out and buy the thing that you want now. Right. And maybe, arguably, it was all a nice bit of ploy to get some economic growth, is push this mass, this thing, inflation's going to come back, and that knowing that will make people think, maybe I should go and buy that Xbox now rather than later. Maybe I should go and buy this new sofa, the new bed, etc. Yeah. Maybe.
Yeah, it
and but also just sort of monthly reporting, the way that things are reported could.
Yeah.
Yeah, I don't know.
I mean, there's another thing that's looming too, which is a government shutdown on the 19th, I believe. We had the same problem a couple of months ago when they were, the U.S. government, when they couldn't get a thing through, and now they're doing the same thing. They changed the Speaker of the House, et cetera, and they always, it's a lot of FUD,
they're a
basically,
bunch
where
of
they're like
fucking children.
yeah. Well, so there's that as well currently. And I don't think that's going to be a nothing burger as usual. I think
it's going to it's going to be news. It's going to create fears amid the stock market's tumbled today amid fears of a government shutdown. It's like, well,
it's a classic headline, right?
What is the government going to do in the next week or two that's going to affect the stock market or in any fundamental way? Nothing. It's not
nothing.
So it's
exactly. So I just wanted to touch on the whole thing because there's so much talk about it all over the place on Twitter, X, and everywhere, and YouTube. Lots of talk about it, and I'm just like, it's gonna be a nothing burger like every single time. Worst case scenario, they have to push through a spending what's it called? The spending whatever thing that they don't really like. Yeah, that they don't really like, and then whatever. Okay, let's go on with our day, basically.
Well, basically, all that is whoever is in power will go, let's raise the debt ceiling because they have to. Then they have to vote for it, and they have to put it through Congress. And so everybody knows it has to happen. Everybody knows it's going to happen. It doesn't matter who's in charge. It's going to happen. They've done it something like 18 times. However, whoever the opposition party is now got into this lovely little game where they demand concessions in return for agreeing to it. And so it becomes this political back and forward about who gets what goodies do the Republican Party demand in order for agreeing to do the thing that they know needs to be done. And it's a game that they both play. They're both equally bad at it. And we just just get on with it. Normal people just get on with your lives. You won't even notice the difference.
Really ignore it, because it's one of those things that they want you to, well, not they, but creating fear, uncertainty, and doubt about the markets is going to scare a lot of people. A lot of people are going to sell off their stuff just in case. A lot of people are just going to wait. A lot of people are going to buy now or whatever if they want. It just creates kind of uncertainty, all that type of stuff. And generally speaking, that type of thing is basically a nothing burger at the end. The market's going to move because of this, as you can see currently. Technically, Bitcoin is currently just like Golden Goose said here. He said that Bitcoin just dropped to 35. Yes, it did before we started. And that's one of those things where it kind of just layers on these odd things one at a time, and then things start turning over, and then eventually things are forgotten and you bounce. So
remember that ETF. Isn't the ETF going to? Has it not sent? Why has it not sent us to all-time highs yet?
Yeah, I'm kind of personally, like I said yesterday during TA Monday, I got out of my position in Solana because I saw the peak, sort of. I got out. Currently, it's good, but I'm waiting for much lower prices than this, and with everything happening with the ETF, like if the Bitcoin ETF is kind of not pushed through by the SEC, because they can still say no and ask for like another version to be written up for them before they approve it, and the next time that would happen, put it through, it's going to be in January, I think.
Okay.
So if that happens, then we're going to see a dump in the markets, probably, because this current market pump was kind of built on top of the whole ETF news thing. And the hype. So
and this is people will fit narratives. You could have found a reason for Bitcoin to have pumped at any point in the last year. You've seen it. it's happened where you've had good news periods, bad news periods, and Bitcoin has just zigzagged its way up all year, slowly disappointing everybody with failed, big rallies, boring periods, and then it rolls over. And there's nothing that's fundamentally changed. And as I've just sort of outlined, there's not a whole lot of people with a whole lot of money right now. Things are tight. You're either feeling it yourself or you know people who are. And you have to please just think back and remember what the environment and the mood was like in 2020, 2021, when the last bull market happened. For those who were there, it was one of people just had money to spend. People had money spare. I had money spare. I was like, a lot of people were sat at home with absolutely no money whatsoever. I had a full-time job, I had a solid wage, and I had absolutely rock all to do. And I got to see Ethereum at $100 odd. Yeah, I'll buy that.
Yeah.
And then, where are those people now? Are they? I can't afford to be buying Ethereum at $2,000. I can buy a bit. I'll keep on buying bits and bobs, but I've certainly not got the same amount of money I had now as I did back then. And that's a case of this, as we've explained, and people can see themselves. This is global. This is not limited to just pockets of the economy. This is happening everywhere all at once, and this is not an environment where exponentially growing highly speculative assets they're not going to succeed in this environment. This is not something you see certain coins that do make these really big fundamental jumps. Good. Well, they will happen.
I mean,
you'll see a lot of them make 50 to 80% corrections, and that's normal.
Yeah. I mean, you got to keep in mind as well, right, that everybody knows the Bitcoin cycle or the crypto cycle is about 4 years, bear to bear or peak to peak ish, right? And a business cycle is somewhere between 8 and 12 years. This is currently the peak or the bottom of a business cycle that we're going through right now. Not necessarily the bottom, but we're going through that type of thing.
I've got a feeling we're still near the peak.
Well, if you look at it, 2008, huge crash, business cycle over, gone. Then Bitcoin was born. So Bitcoin has not gone through this. The crypto space has not gone through this, the whole business cycle thing yet. And who's to say that we're going to get, the classic cycle? I mean, there are arguments for giga drop and also a new all-time high that far exceeds, what we currently have because of, the end of the business cycle. Who knows? We just have to wait and see, really. But, in a macro perspective, we're not looking at a crypto bear market. We're looking at a business bear market.
We're looking at a global. Really, we're looking at a global recession. This is
business cycle is usually where the recessions come in, right? So.
Yeah, and it's pretty clear. I say just stick my chart.
Yeah, I was just about to say you were poking around there.
Yeah, so you have to think. So here's the S&P. I'll just add US recessions on. Once it loads.
That's fast.
Okay, yeah, loads of recessions. So this based on the back of this. So everything that we're just laying out, you have a high debt, high interest environment. You have the best. The safest yielding asset in the world is 5%, meaning that everything else has to charge more interest than that. You have people increasingly suffering under cost of living. You've got rents at unsustainable prices. You've got people just getting older and low birth rates. So you've got an aging population. You've got all of these things all just weighing the economy down all at once. And the idea that we can just, what is the best scenario that you can think, where we just suddenly just snap back into a world of economic growth and prosperity? we've had that for the last 10 years, and it didn't really feel to most people like a bull market. There's a bull market for a lot of people, where a lot of people got very rich. Those who had access to credit in record low interest rate environments, those people got very, very rich. The average person didn't get any richer over the last decade, despite what the stock market is saying. Yeah, I would certainly say so. The average person got poorer. Our iPhones were much nicer. We got nice shiny phones.
Yeah, well, that's nice.
But if we didn't have those, apparently we could all afford houses. Even though just taking the go on.
I was just gonna say we're not sponsored by Apple though, but you know, Tim,
Well,
if you're watching, just call us, man. Call me.
Or any other glass-covered rectangular cuboid
device
provider.
Yes.
Yeah.
Thank you.
But yeah, like, does it feel like stocks should be at all-time highs or approaching all-time highs right now?
Yeah, that's the thing. No.
But go back to sort of the example I said of this global lack of dollars during periods of financial tightening. You've got the overall availability of dollars globally reducing. So what does that mean is that if you're somebody who wants dollars, all of a sudden buying the S&P 500 is actually less risky than holding your own currency. You will hold anything which is dollar denominated will do better than your own currency. And I'll just give a easy example. If I do the S&P divided by sorry to pick on any Argentinians, but the Argentine peso. This is the US stock market in pesos since 2013. Could you pick out the bear markets for us?
Oh, barely, right?
Literally, there isn't one, and this is look, there's one. But this is the in foreign currencies that the risk of holding their own currency is much higher than owning stocks. So all during periods of uncertainty, all US assets become safe havens.
Yeah.
And so the US, that's why the US seem to be so late to the parties, because they're looking around going, is everything okay? Yeah, okay. In a country where like 26% of people have passports, so most people haven't ever been outside and recognized there is actually a whole world suffering because of
there is other stuff out there, guys.
and the whole world is suffering as a result of US economic policy. Meanwhile, the US are going, oh, do we need to push higher because our inflation rate is 4%? Meanwhile, you've got countries suffering triple-digit inflation rates with no way out, and their only way out would be access to dollars, which they can't get hold of because they're being sucked out of the system. And it's just a vicious cycle, and eventually the world's largest consumer, the US, suddenly realizes that all that shit that the rest of the world makes for them that they want to buy, they suddenly realize that all of the manufacturers are going out of business because they can't pay their debts. And that's, this is how global recessions happen. This is putting pressure on a system until something breaks. And there's no reason why Bitcoin can't carry on going significantly higher. Just to say, bringing it back to crypto, Bitcoin could sit, and so as we mentioned yesterday, that this bull market looks a hell of a lot less like 2018 and 19, and far more like the previous bull market, 2016, 17. This is the kind of behavior that we're exhibiting almost to a T. And so that this as we saw, this went on for a hell of a long period of time. Alternatively, if you're a follower of the extending cycles theory, well, maybe we're still in this period. Who's to say we're not kind of here? And as we're saying, I'm not calling for that to happen by any means, but if you consider, I'll put the Nasdaq on actually, because it just gives a bit of a better comparison. It's quite clear that when the Nasdaq does well, Bitcoin does well, and if we put recessions on, if we go all the way back to it's not going to show me. I'll have to just go to the Nasdaq.
Yeah, I think it only shows all the way back on the BLX thing.
Yeah, I'll swap it around. I'll put BLX there. There we go. So yeah, overall, the Nasdaq has been up only mode for pretty much the entirety of Bitcoin's life.
Yeah,
but Bitcoin has still followed the overall macro moves since it became big enough to be important.
Yeah,
I mean, even if you look at the sort of this period here, this 2014-15 period, here was this was a kind of, a lot of countries did go into recession during this sort of period in 2015, and Bitcoin may well have sort of front run that kind of sentiment.
Oh yeah,
it
does on the other peak as well,
Yeah, well, let's say that, but alternatively, it was just Mt. Gox, and that's also it's perfectly reasonable to think that if Mt. Gox hadn't happened, it would have just kind of carried on meandering up and done what it did anyway, following the overall market. And then since 2017, it then became more and more of an institutional grade asset, and since then we've become we follow what the markets do broadly. And right now, the stock market, the Nasdaq is in white now. It's breaking out. It's not very far away from what is it? Yeah, it's like 5% from all-time highs. And but if you do agree with the thesis that a recession's coming, well, the recessions generally aren't very good for speculative markets, and tech stocks are far more speculative than average markets. We talk about the likes of Tesla, where Tesla has like a 75% drawdown once a year, and whatever you think of it as a company in terms of where it's going, a lot of its value proposition is based off what it's going to do in the future, not what it does today. And so it can be heavily sold, and all of its bullish narratives just hold perfectly, and over a 5 or 10 year period are completely accurate and completely true. It can still drop 75%, and does, year after year after year. Bitcoin is no different than that. And if we see macro rollover and drive us down lower, to think that crypto won't follow, and won't follow nastily, because as sort of mentioned, we've now given a lot of room to drop. Things are now heavily oversold on the weekly. I've overbought on the weekly in many coins. Like, yeah, this could just reject and roll over any moment, and it could go all the way back. And crypto, a lot of cryptos will set new lows in this cycle. But they could. This rally could go on. The Nasdaq might break new all-time highs. It could keep going until January, February, May. Who knows? Because right now, say the world is still, the US is still sucking in capital, and things can continue to deteriorate before things break.
I mean, can you imagine what happens with crypto miners if, the big crash comes after the halving, and Bitcoin price goes back to let's say 20K? A lot of miner companies were in deep trouble when Bitcoin was under 30K, and then
a lot of mining companies will be in deep trouble.
Oh yeah, there's a few that will survive. I don't really do stocks that much, but I've looked at a plethora of mining companies, and a lot of them will not survive. Even a lot of the good ones.
I can give you a chart. Of course I can.
Of course you can.
Of course I can. So this at the bottom, these are the hash ribbons. And this is it's open source code. You can get it, and it basically just looks at the blockchain hash rate, which is on TradingView and available to see, and it basically just plots the moving. It's a moving average rate of hash rate, and as you can see, even on its own, it is a quite delightful indicator of bottoms or or opportunistic buys, should we say? Let's see. Let's just put it in. Yep.
Alt J.
Alt V. Alt V. There you go.
Yeah.
I was pressing Control and V, and so it's not necessarily getting perfect timing, but pretty much every time it does happen, you get a pretty. It wouldn't be a bad time to buy, or and the thing to notice though is how often these signals are arriving now, and these signals used to be far less frequent. Like they're going all the way back. This is 2012. You got a few buy signals similar to today. You got a whole heap. You got three sort of in the bottom here, but
I don't know if it's because now that the hash rate is going up and it's becoming this massive business, where the hash rate is just completely exploding. Back in the day, it was more like, hey, let's mine some Bitcoin. That sounds like fun type thing. And then after that, it became a business, and now it's a massive business. And if there is a recessionary crash in the markets, like, mark my words, Bitcoin will follow that crash more than likely. And if that happens after the halving has occurred, suddenly then Bitcoin, instead of needing to be over 30, needs to be over 60. Because the halving, for them to be profitable. And that's if the hash rate stays the same as it was, which it won't. There will be a huge dip in hash rate at that point.
So this is what you have to consider. Is so the hash rate, like you say, exploding, and similar happened in 2020, 2019, 2020 as well. And the hash rate went up considerably. If I just go there, oh look, that looks familiar to what we have today. Yeah. Basically the same thing. And hash rate on its own is a pretty good predictor of where the global energy market sees Bitcoin going. And you have to think what Bitcoin is at its core is it converts energy into this asset.
Transferable value.
Yes. It is a method. So I've explained this sort of well before, but it's I won't go into it too much today, but it is essentially a method of transferring energy from where it is abundant to where it is scarce. And there are more and more mining companies identifying this niche, whereby if you have anywhere where you have an isolated pocket of energy which cannot be used, if you're out in, so particularly say the middle of the desert, if you have oil fields out in the middle of the desert, they have what's called flare gas. So as they're drilling for oil, there's a certain amount of gas which comes up, and there's not really much way to deal with that if you're not set up to actually extract gas. This gas is kind of just a waste, and it's a hazard. And methane is actually a horrific greenhouse gas. It's around 20 times more of a greenhouse gas than CO2. So the most environmentally friendly thing that they can do with this gas is to just burn it off. And you will see quite often in oil refineries, that's why you see these flames at the top of chimneys. It's just gas being burnt off because there's rock all to do with it. But you can attach a miner to it. You can actually take that extracted gas that's just otherwise a waste product, and you can go, no, we won't just burn it out the top of a chimney, put it through this generator and use it to mine Bitcoin. All of a sudden, you now have created hash rate using zero cost. So what is the cost of producing that hash rate? It's the cost of appreciation of the miners. That's all. And you can even use older miners because, well, your capital expenditure is your only cost. If you can pick up S9s that are still perfectly viable miners, they're just not super. They're not very
efficient.
Yeah, they're too inefficient to mine profitably. in a normal place with normal energy costs. But if your energy cost is essentially free, you have suddenly got access to gigawatts around the world of energy, which can produce economic value for virtually no cost.
Yeah.
And that I believe is what we are seeing overall, is the world slowly come to this realization. And the more it happens, the more you will see the cost of energy essentially equalize over the planet. And Bitcoin is the prime mechanism to be that arbitrage, where it moves energy from where it is cheap to where it is expensive. And in doing so, it will iron out those inefficiencies.
Yeah. Fun fact, I think this was the argument that Orange pilled Jordan Peterson.
It was
on video.
This was the essential argument. And in that case, people call Bitcoin digital gold, and I would like to caveat and say it's actually digital oil. And if you think about oil, you can't just dig
digital energy.
It's digital oil in the sense that you can't just dig into the ground and spring oil. You can't do it. It's not possible. In exactly the same way, you can't just hook up a miner and profitably produce Bitcoin. You can only produce oil where the amount of work you put in is less than the economic value you pull out of the ground. And you then take where it is cheap and abundant and pouring out of the ground, and you put it on tankers and you transport it where it is scarce and valuable. That is exactly
your mic is lagging up, by the way, a little bit. No, it's fine. We could still hear you. It was just kind of quiet.
Well,
anyway, yes, you're right. Again. But I think we should round this off now, because we're approaching an hour, and we said keep below an hour, and I think we've gone through everything that we wanted to, right? For once, we actually made it in time. Yay. Okay, so as usual, everybody, make sure you like, subscribe, notification bell, join the Discord. We're gonna jump in there right after this if you want to hang out a little bit, if you have any questions in regards to everything we talked about today. And we'll see you in the next one. I think on Thursday I'm going to try to do a video. I'm not sure what it's going to be, but it's going to be a how to use something. How to something, probably the RSI, because I use it so much and I just feel comfortable just tossing that out there. So it should be good. Cool. We'll see you then, and cheerio.
Bye.